we're going to go through the economic chart book for the Secret Squirrel Society. Just as a reminder, these predictions, which are not many, are based on a very fundamental model in which we're looking at capital accumulation and the dynamics around that. So it doesn't account for a lot of things that are changing the economy. So that would be the oil shocks, artificial intelligence changing the form of the production function in small ways. The deficit, it doesn't really account for that. The debt, it does show up in the error and the inflation for the model, right? And then a lot of other things like net exports. I know the tariff situation's changing quite a bit, so it doesn't account for that kind of volatility. Knowing that the deficit and the debt and the way to finance that debt, which is basically to print money, usually will show up in inflation. It would be unusual for it to show up in hampering investment. And then artificial intelligence, we're really accounting for that in terms of how the production function looks, how do entrepreneurs put capital and labor together to produce product. That's changing. So it'll show up in how the model misses on the labor market. So let's go over this very quickly. I think the macroeconomy is like a huge ship. It takes a long time for things to develop. So the things that are fundamentally changing the economy, the labor market's changing due to AI, there's oil shocks, and there is a deficit spending problem, which will show up in inflation. And then what Trump did with the tariffs is he also got a lot of foreign countries to invest domestically. That is the big driver of growth and jobs. So you have two counteracting effects. And also AI does have a side effect of huge domestic investment in terms of these data centers. So what you'll see in the model, which is capturing some really fundamental relationships, is that the model is off because of these factors. So with that said, let's go through the chart book very briefly. So let me make that a little bigger. So if you looked at the other podcast, basically we're looking for the second half of 2026 to be a jump off point. The model predicts to the right of the red line that there'll be a small jump in the goods market, GDP, and this is real GDP. And then going into the fourth quarter, a sizable jump where you're getting about 2.75 to almost 3% growth. And then the year-over-year growth will greatly exceed that, closer to 3.25%. And then as we go towards the second half of 2027, it'll still be pretty high, but it'll dampen out. So by 2029, you should see something around the 2% rate. Now, when the goods market has this kind of shape, what's going to follow is the consumption market, or the market for consumer goods, because essentially the GDP reflects people's income also, profits and income, wages. So you do see something similar. You see a lift in consumer spending. It was about 2.25, somewhere in the middle, year-over-year growth. And then you see it kind of slowly ascend following the spike in GDP. And it kind of peaks out about the same time, maybe a little bit after. And then, as you can tell, it will dampen out. And then what we have in this model is the long run behavior is dictated by economic fundamentals. So what does that mean? That means that the goods market and the capital market will be in equilibrium, and also the labor market too. So what it's going to reflect is some really fundamental consumer and producer behavior. Capital formation. Now, data for capital is really tricky. So what I did was create a proxy for capital based on investment spending. And if you do the algebra behind the typical capital accumulation model, you'll get something to the effect of a pretty linear relationship between investment spending and capital formation. So this capital formation number doesn't get updated very often. So that's why I have to use proxy. So what we're seeing is basically the upward effect. It started in last quarter, the upward effect of this domestic investment. Much of it by foreign companies, a lot of it from data centers. You see it really go to a high level second half of the year into early 2027, and then it dampens down. So I kind of expect that pattern to be realistic. I think there's a huge push for data centers. There's domestic investment from foreign countries, and that will kind of level out after a while. So you're looking kind of near the second half of 2028 into 2029, where it kind of levels out to a level comparable to where it was back in 2025. Labor market, you saw some initial change, I would guess, in the production function where labor is not as needed as much, and we're considering AI to be a capital P product, right? So what you see is kind of the data showing a spike downward, and that means people are kind of getting laid off due to AI. But we have noticed a pattern where the companies are kind of feeling it out. They're trying AI to lessen the labor force in favor of capital. However, what I think they're going to find out is many of the jobs, the AI doesn't do an acceptable job, so they're going to start rehiring. And then with any kind of technological change, there's a changeover in the labor force, whereas new jobs are being old jobs are being eliminated, but new jobs are being created. That will take some time, but I think what this shows is sort of a drop due to AI and tech-related jobs, but then you see an expansion in the whole economy in terms of the labor force. And that would possibly be due to the productivity gains from AI. So I do see in the third quarter, this is total employment year over year, it actually growing year over year going in Q3. It has been negative, but I believe it will turn the corner this quarter. I think some preliminary numbers are kind of showing that. And then it'll kind of take off. Will it be this high? I don't know. I'm kind of hedging my bets. But my guess is you have corporations kind of looking at their staff and looking at their ways of doing business, finding ways AI can do a better job, and then finding out they're going to need more labor to do certain things. It could be just fixing what AI messes up, which I was just telling a friend yesterday, that's a tough job because I've been managing people for 20 years. The toughest job is to clean up somebody's mess, and I've had to do it a lot. So you do see things kind of spike in 2027 and then kind of gradually go to equilibrium. This is your typical macroeconomic model. When you go way far in the future, the expectation is a long-run equilibrium where capital markets, labor markets, and goods markets are in equilibrium, and they reflect what optimizing agents, those would be consumers and producers, would do in a very fundamental level. So prices are the interesting thing. I think this is the variable to look out for. Now, normally you would say that inflation behavior is fundamentally money driven, right? So if money aggregates go up, prices will go up. It's just fundamental facts. That can be mitigated by supply shocks, which is there's more on the market. So in spite of there being more money in circulation, there's more goods. And so that is reflected in lower inflation, still could be inflation. So what you are seeing, according to the model, is the Fed will lower interest rates. That's that big blue hump. But what's going to happen is the price level will not follow percent-wise. It's going to kind of moderate because the economy will be growing. So this is consistent with what the other graphs show, that the investment spending is going up, the GDP will increase, and eventually the labor market will catch up. So that's somewhat optimistic. I do see a pretty high inflation rate, but this is according to the GDP deflator, right? So, what I deal with in this model is very fundamental. real output, real consumption, number of workers, real capital. When it comes to nominal measures, I like to use the GDP deflator. The Fed likes to use the consumer price index and variations on that. But this GDP deflator is actually all prices. This reflects all prices. And if you look at something that's very fundamental to macroeconomics, like the quantity theory of money, I think these aggregates reflect that quantity theory of money relationship more closely. So that would be M1, which is the most liquid form of money supply, and then the GDP deflator, which is a very wide measure of prices. So those are the measures. And again, I'm not the type of economist to have a million predictions on a million things. I'm not going to comment on some things that are kind of in the news. I comment in the beginning, but they're not embedded in the model because they're not fundamental to macroeconomic behavior. They're shocks. I would consider them shocks. So I don't run this model with any subjectivity or with any shocks. So given that, I'm pretty pleased with the performance of this model. And again, just a very fundamental model capturing, investment behavior, consumer behavior in terms of savings and consumption, production behavior, and the subsequent labor market supply and demand, right? So these are just very, very fundamental measures that the model is doing. And given that I want to have a fundamental view of the economy, surprisingly, the model is fairly accurate in a pretty unstable environment, I would say. So what I predicted for GDP, real GDP, year-over-year growth was 2.17 last quarter, and it was 210. So that's pretty good. I'll take it. And then consumption is actually underpredicted in this model, 2.26% as actuals versus 1.79% growth. I think that might be a little bit of a surprise given the labor market situation, but it could also reflect credit. I work in credit. We're concerned with how the economy is going for the consumer, and this could reflect credit, keeping that afloat. Total employment. So this again is not unemployment. This is total employment. It dropped 57 basis points where my model predicted 15 basis points. I kind of attributed that to the fundamental changes in the economy happening due to AI. My own personal reflection is I think people are feeling out the impact of AI, and some of these changes that they're doing may be reversed. And I kind of see evidence of that. GDP deflator, I underpredict 3.71% versus the actuals being 4.33%. And again, this is a year-over-year measure. This may get convoluted with what's reported on the news. It's a different measure. I think this is fundamentally due to the oil price shocks, all right? And there is some possibility that the Fed is basically going to have to monetize the debt. And when that happens, maybe inflation expectations go up. So that might have some effect on the GDP deflator now. One comment about the debt markets for government bonds. I think you're really seeing investors waking up to the fact that there will be long run inflation, right? It's going to be persistent. And people that are holding 30-year bonds, that's priced into the 30-year bond, especially, which is a long-term inflation expectations. There's a mountain of debt. It's only going to increase, possibly spiral. And I think the long end of the curve investors are saying, you're going to have to give us a discount on these bonds because we don't want to hold them. There could be some serious inflation down the road. Will there be serious inflation down the road? It all depends. So this is a very easy game the Fed and the government's playing, which is you can't tax your way out of it, right? You can't tax your way out of $40 trillion. You could sell assets, but that's never on the table. I don't think the government wants to sell their assets. What's another way to get out of it? You could do some fancy financing tricks, but I think the market sees right through it. The only real way to do it is for the Federal Reserve to basically buy the debt and put money in the economy, which will cause inflation. Now, will it cause inflation for sure? Not exactly, because if you have a high rate of growth in your GDP, your real GDP, it will mitigate the inflation. So in other words, you look at the M1, M2 money aggregates, you can tell when the Fed is increasing, and what it says in the news is the interest rates are dropping. So that's one factor that could happen. That affects nominal values. But when you put more goods on the market, you increase supply. So what happens, just going by the simple quantity theory of money, that growth in GDP, which is predicated on the investment spending now, which we can see is going up, it's going to mitigate that inflation, right? So I think that's a really strong indicator right now that the market's a little jittery. They don't think growth will keep up with the rate of monetary growth. So the growth of GDP, real GDP, will not keep up with the monetary aggregate growth, which is analogous to the interest rates dropping, which means you're going to have some long-term inflation. When inflation expectations get out of control, you might have some serious, I would call them, economists call them corner solutions, which is you might have some hyperinflation, and that would be a total disaster, especially since the dollar is a reserve currency. But we're going to see what happens. However, I have a very fundamental model. I don't want to put everything in this model. I just wanted to have a very fundamental view of macroeconomics. And I think it did a pretty good job under predicting by 62 basis points, but still reasonable. I think it could start really under predicting, depending on how people get carried away with this expectation of inflation getting out of control. Investment capital, capital formation, under predicted by 115 basis points. That's not terrible. I think this, 115 basis points gap is basically due to the fact they're just really going nuts with the data centers. It's causing a lot of community upset, but they're really hell bent on putting a new infrastructure in to support AI and robots and possibly government surveillance. So I think the model's doing a reasonable job, right? Again, just taking into account fundamentals, not taking into account the latest news. I do predict M1, but it's kind of a crapshoot. You never know when the committees at the Fed will change their mind or, outvote each other on differing views. So I think it does pretty good. We overpredicted by 49 basis points. I think that's reasonable. So I think overall the model's doing a reasonable job. It's not picking up on some of the really headline news things that are affecting fundamentals, but essentially it's keeping up. So pretty pleased with it. I think we'll find out Q4 to see if we do see a spike in growth and maybe even an increase in labor. I think inflation is probably still going to keep going up. It's going to be over 5% possibly. So we'll have to see what happens, but we're going to get back and circle back in Q4 when it'll be happy holidays. So thanks so much for dialing in and appreciate your time. Sorry, jumping around here, but anyway, hope you enjoyed it, and let's see how I do. Talk to you soon. Take care. God bless.